Hello everyone. Welcome back to Your Money Your Way. Today, we're diving deep into Sabana Industrial REIT, ticker symbol M1GU on the Singapore Exchange. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Sabana REIT has been in the headlines, showing operational strength, but also facing unprecedented challenges with its management structure. Is it a hidden gem trading at a discount? Or is the risk too high right now? We'll break down its financials, operational health, the massive internalization challenge, valuation, and future outlook based on the latest available information. Stick around to get the full picture. Sabana Industrial REIT invests primarily in 18 industrial properties across Singapore. Think high-tech industrial spaces, warehouse, and logistics facilities. Its portfolio was valued at just over 915 million Singapore dollars at the end of 2024. Historically, their strategy focused on enhancing existing properties for organic growth. They've also emphasized sustainability, aiming to be carbon neutral by 2040. Crucially, Sabana REIT is currently managed by an external manager owned by ESR Group. However, since mid-2023, the REIT has been embroiled in a complex process to internalize its management, essentially bringing management in-house, owned by the unit holders themselves. This internalization saga is the dominant theme right now, and we'll explore its impact throughout this analysis. Financially, there's good news and some caveats. For the full year 2024, Sabana reported record gross revenue of 113.3 million Singapore dollars and net property income of 57.5 million Singapore dollars, up 1.3% and 4.5% respectively year-on-year. This momentum continued into the first quarter of 2025, with NPI jumping 22% and distribution per unit surging 26.5% year-on-year to 0.86 cents. Sounds great, right? But here's the catch. The declared DPU growth in FY 2024, 2.86 cents, up 3.6%, was achieved despite the manager retaining about 10% of the distributable income. Why? To cover the significant costs associated with the internalization process. So, while operational income grew strongly, the DPU you receive is impacted by these extraordinary costs. This retention masks the true underlying distribution potential and raises questions about sustainability if these costs persist or increase. Operationally, it's a mixed bag. The standout positive is rental reversion. Sabana achieved a stunning plus 20.6% for FY 2024, marking the fourth straight year of double-digit positive reversions. Q1 2025 continued strong at plus 15.3%. This shows strong demand for their renewed leases. However, overall portfolio occupancy is a persistent challenge. While it improved slightly to 86.4% in Q1 2025, this followed a drop to 85% at the end of 2024, down from 91.2% end 2023, mainly due to repossessing to master-leased properties. Critically, this occupancy rate remains significantly below the industrial sector average of around 93.5%. This combination suggests that while occupied properties are performing well, there are challenges in leasing up vacant spaces, possibly in older or less desirable assets. Tenant retention within the multi-tenanted part looks good, hitting 99.7% in Q1 2025, though the master lease issues highlight past concentration risks. Looking at the balance sheet, Sabana's gearing ratio has crept up to 37.8% as of March 2025, still below the 50% limit but higher than the end of 2023, 34.3%. Net asset value per unit has declined to 0.50 Singapore dollars from 0.5 to Singapore dollars, and the interest coverage ratio has tightened to 3.0 times from 3.5 times. These trends rising debt, falling NAV, tighter coverage, and increasing financing costs, 4.57% in Q1 2025, point to reduced financial flexibility. This is partly due to market conditions, but the uncertainty around the internalization process likely adds pressure, potentially making lenders more cautious. Now, let's tackle the biggest factor: the internalization of management. Driven by activist investor Quaz Capital, unit holders voted in August 2024 to remove the current external manager owned by ESR Group and set up an internal one. Quaz argued this would save costs $$2.4 a year, better align management with unitholder interests, unlock value through better strategy execution, and address perceived underperformance and conflicts of interest with ESR Group. The outgoing manager and ESR strongly contested this, warning of value destruction and significant risks. This process is unprecedented for Singapore REITs and carries major risks. Financing risk. How will lenders react to the change? Will borrowing costs increase? The auditor even issued an emphasis of matter initially regarding this. Execution risk. Can this complex transition happen smoothly and on time? Estimates suggest at least 12 months and more EGMs. Costs are already significant, hitting 5 million Singapore dollars in FY 2023 alone. Governance risk. Can a new, effective internal team be established? ESR stake overhang. ESR Group still owns over 20% of Sabana. What will they do with this stake post-internalization? A sell-off could pressure the unit price. Adding another layer of complexity, at the April 2025 AGM, unit holders voted against giving the manager the standard authority to issue new units. This severely restricts Sabana's ability to raise equity capital, making it much harder to fund the very asset enhancement initiatives, AEIs, and potential growth that internalization proponents aimed for. It's a major constraint. So, how does the market view Sabana REIT? The unit price, around 0.36 Singapore dollars recently, has underperformed the market and its sector peers over the past year. Valuation metrics show a disconnect. It trades at a significant discount to its net asset value, with a price-to-book ratio around 0.72x. The forward dividend yield is attractive, estimated at over 8%. However, analyst sentiment is generally cautious to negative. Citing internalization risks, consensus points towards a sell. This suggests the market is demanding a hefty risk premium for the massive uncertainties surrounding the internalization. That high yield comes with strings attached, significant perceived risk. Looking ahead, Sabana REIT's future hinges on navigating this internalization successfully while maintaining operational strength. Potential upsides include cost savings from internalization, if successful, value from AEIs, if funding can be found, and improved occupancy. But the risks are substantial: internalization failure, rising financing costs, inability to fund growth due to the AGM vote, stagnant occupancy, and the ESR stake overhang. So, what's the verdict for investors? Sabana REIT presents a high-risk, high-uncertainty investment case right now. While operational aspects like rental reversions are strong, the internalization process dominates the narrative. It's unprecedented, costly, and fraught with execution and financing risks. The recent rejection of unit issuance authority adds a major hurdle to future growth plans. The attractive yield and discount to NAV reflect these significant risks. Investing here requires a very high risk tolerance and close monitoring of internalization progress, costs, financing stability, occupancy rates, and ESR's actions. Until there's much greater clarity, caution is warranted. What are your thoughts on Sabana REIT? Let me know in the comments below. If you found this analysis helpful, please give it a thumbs up, subscribe for more deep dives, and hit the notification bell. Thanks for watching, and I'll see you in the next video.